what happens to that 400 to 600 billion dollars is going to be very important for 2026. Do we take that and put out stimmy checks? That's obviously just going to be probably a net positive, because you're taking money from corporations and probably giving it to individuals.
Do you think that would help to accelerate through any kind of downturn that would occur at a macro level?
Curious how you see these two like kind of crypto phenomenon affecting the broader global macro picture. Welcome back to The Roll Up.
This is your home to learn from the biggest guests, the brightest minds at the tip of innovation.
Our goal is to help spread the collective knowledge of everyone in our community.
We are breaking crypto out of its echo chamber and taking it to the real world.
Deja, welcome back to Roll Up TV, man. A lot has happened since we had you on last with your trade after the trade article and post, I think back in April. Bitcoin's all-time highs. We'll give you a little confetti for that, for calling that one right. I hope your portfolio is looking good, man. Good to have you back.
Thanks, man. A lot's happened for you guys too. You guys have been killing it. Whole rebrand, killing the live streams. It's feels like there's been a lot of traction on your guys' end too since the last time we chatted.
Oh, thank you, brother. Yeah, it's been fun. I was just out in Seoul and Token as well, running the Asia conference tour. I think you were there as well. Any takeaways? What do you think about the Eastern Hemisphere these days?
Yeah, so I was actually only at Seoul. I had to come back, so I didn't make it to Token 2049. But yeah, that was my first time at an Asian crypto conference. It is, yeah, it's that's where retail is. Hey, man, like they're just, it's full on. People are like, "Where's retail?" Yeah, they're in Asia. They're in Seoul. There is just. I was walking through one of the, I went by, like, I was there for the Origin Summit, but I went by the Korea Blockchain Week conference, and every booth, people are just lined up like crazy, trying to win something for free, trying to sign up for something. And it's just like normal people, you know, just like not crypto industry people. It's just people that are just interested in the whole world. It's, yeah, it was really interesting comparing that to the US, where it's like all just suits and, you know, BlackRock and that type of thing.
Yeah.
Yeah, it's just like a different vibe. I mean, it's speculative driven. It's they've got the inherent kind of I don't know, you know, gambling culture, or just kind of, you know, go to the park and play dice or play dominoes, or, you know, then that leads into what I saw was people in Korea doing perps trading live on a big screen there. So that whole kind of like culture is just,
you know, I'll say I think it does run a little bit deeper than just gambling, because it really feels like there's some hyper-financialized capitalistic attitude in South Korea, and I think part of that stems from their very close neighbor being a rather communist, authoritative country, and they've really got this cultural identity that says we're not them, we're going to be our own thing, and that's going really far in the other direction, which is super capitalistic, hyper-financialized markets about everything, and that really runs through their culture.
Yeah, big time. It's also interesting, like I've traveled to other Asian countries, but mostly tourism destinations. And it was one of the first places where I've been to where they're such a economic powerhouse, where, you know, they have Samsung and everything. So like, why do you need tourism there? So nobody speaks English, and it's a very rich country. And they're doing really well. It was really, really interesting to see.
Yeah. Well, there's
welcome Felix to
ton of fun stuff to talk about.
Money Moves Fast episode 4, Rob. This is our premier tokenization payments macro kind of show. We looping you in here today to bring the macro picture that kind of will balance out some of the stable coins, tokenization, kind of stuff that's happening in the crypto sphere. So Rob, pass it to you. I know you just had a great pod with Arthur Hayes. Maybe you could set the stage here for Zhao to kind of give us some of his takes.
Zhao had a great combo. I think just a few days before I did, because my conversation was at Token in Singapore. And so one thing that I gleaned from Arthur during our conversation, as well as in his second to last piece, 4-7, which is the best hand in presidential poker. And he described the outlook for Trump and the Fed and the generic monetary policy that the US is moving towards. And if Trump can get a fourth governor in the federal board of the governors, then he can essentially take control of the Fed and control the monetary policy, which is really important for him to enact his fiscal policy ahead of the elections in November, because if the Republicans lose the midterms, then he would still have the Fed to really enact his power and his control. And so in the last Fed meeting, we saw 2 governors dissent. There was a third one that kind of, you know, spontaneously resigned. And now this fourth one is all up to Lisa Cook. If Lisa Cook gets cooked, then Trump takes control of the Fed and he can basically use the Fed to his will. And so, Fiscal, you're the macro expert here. How do you see this landscape playing out? And what were some of the takeaways that you had from your conversation with Arthur in after your podcast in Seoul?
Yeah, it's a wild macro backdrop right now. Like the fact that we are suddenly in this situation where we're trying to piece apart and game out the scenario analysis around a takeover of the Fed effectively is just like wild. You know, we've been through these regimes before. Like if you look at the long history of the Fed and how quote unquote independent it is, we've had times where it's basically just subservient to Treasury and therefore the presidential administration. Last time that happened was in the 1940s, basically. And that was the outright yield curve control, which Arthur talks about in his piece where he's saying that's where we're headed. I likely agree. You know, we could talk about semantics and whether that's like a overt yield curve control where they're like, all right, you know, we're not letting 10-year yields get above 5%. And if they are, we're going to buy unlimited amounts until they come lower. Or did they go for the soft version, which you can make the argument has already been going on for a couple of years now. That's the whole Yellenomics, or as Arthur calls it, bad girl Yellen type policies, where it's like, all right, we're gonna issue a lot more T-bills than bonds and just starve the market of duration, which effectively mechanically is a very similar thing to quantitative easing, basically. So yeah, it's a crazy time. It's been a really interesting trajectory. So as you mentioned at the start of the show, last time I was on here back in mid-April or whatever, I wrote that trade after the trade, and it was really going forth into explaining how with this debasement trade that's become quite popular recently, it was really beginning to explain some of those ideas, and those ideas have held ever since. So it's high fiscal deficits, it's a weakening of fiat currencies meaningfully, and this is what's always confusing for people is that you look at the DXY and you're like, well, it has, you know, it went down a lot in the first part of the year, but it hasn't really gone down since. But FX pairs are always relative to other FX pairs, so you have to consider that. But it's kind of like all FX fiat currencies are melting at a similar pace, so you don't really see it in the rate differentials. But yeah, we are in this debasement trade, well underway into it now. You know, that thesis looked really good for a few months there. We saw Bitcoin rip. That felt really good. And then in the summer, I started to slow down a little bit in terms of my bullishness. I was mentioning how I felt like it was time for gold to take the baton from Bitcoin for a little bit for a few months. And that's, you know, I was about a month early on that call, but it started to really happen. And, you know, the past month and a half, Bitcoin's been pretty crappy up until the last week or so. And gold was really setting the stage there. So that happened. And then in recent, go ahead. Yeah.
Could I just jump in? What were some of the mechanics that you saw in the market that led you to the conclusion, look, it's time for gold to take the baton and run with it?
Yeah, so one was seasonality. I'm not a huge seasonality maxi, but just I've been through enough years in markets at this point to recognize that end of August is not really a great time for risk assets. At the same time that just the technicals were looking really good for gold. It had been consolidating for 4 months. It just looked like it was ready to break out higher. And what we've learned over the last few years is that it's rare to see gold and Bitcoin go up at the same time, which is, it's funny I say that because today is a day where gold and Bitcoin are going up at the same time. But generally speaking, it's sort of like one goes and then the other one catches up. So it just felt like it was time for that to happen, that we got a little stretched in terms of Bitcoin running and gold consolidating sideways. So yeah, it was a bit more market structure type signals that I was looking at. And then that played out. And then in the past few weeks, you know, I was kind of really confused about the price action in crypto, honestly, because I am very, very bullish on the macro structure. You know, equities were looking great, gold was running, but Bitcoin and crypto were doing really badly. And I was a bit confused about why I'm perplexed. Obviously, I knew that, you know, early September, mid-September, it's not really a good time for crypto almost ever. But it still didn't quite make sense to me. And then we got this SEC news that dropped that digital asset treasury companies were being investigated for insider trading. And then everything started to make sense. And it was, if you go back and look at the chart, we bottomed the second that news came out. We bottomed at like 109K. And then I put out a few and I was like, all right, that makes way more sense why we're getting this idiosyncratic sell-off, because all these insiders, you know, they're talking to 200 plus people. So all these 200 plus people, they're like, oh crap, well, I better sell some crypto because they're, you know, the show's over. The DATs are getting investigated by the SEC. And so it all got front run. And so I put out a tweet and said, all right, I think that's the bottom. I think it got front ran. Now we're going to see this catch up back to where it should be trading based on macro. And then we've seen obviously the run from 109 to 125 since. So yeah, it's looking good.
And as of yesterday, the post kind of now forward looking from where we are today from you that has gone viral is, every country is pivoting to running it hot. We're going to run as wide of deficits as possible to try to outgrow the debt. I think there's some stablecoin commentary to kind of be had in there as well. Central banks are giving up on inflation and fiscal dominance is arriving. Nominal assets will do well. Debasement hedges will do even better. The world of 2010 to 2020 is no longer reset your priors, LFG. Let's talk about this kind of forward-looking thought process. So nominal assets will do well. Debasement hedges will do even better. The last decade doesn't really apply to the next. Kind of talk us through what your mental model is for investing in the next, five-ish years with regards to nominal assets, debasement hedges, kind of where you see people allocating capital and the broader trend. I think it's the debasement trade, but perhaps you could kind of go a bit more in depth.
Totally. Yeah. So the reason that I put that out was we had the Japanese elections happen in the last couple of days, and the person who won, first woman prime minister, and she's pretty far right compared to what they've had historically. And she's running on this platform of cutting taxes a ton and basically running the economy hot. So similar to what we've been seeing already in the US and, Europe got a lot of this. There's different reasons for this idea of running it hot. For some countries, it's about increasing their fiscal deficits to increase their defense spending. That's sort of what's going on in Germany and Europe. So there's parts of that. And there's parts of just this giving up of central banks in terms of their inflation targets. So, they're never going to say it outright, but it's quite evident that when you're getting the type of rate cuts that we're getting across the board. I saw an interesting chart from Bank of America where this is the first time, I think, since 2008 that we've seen no central bank hike in the world for the last 2 months. So we're just in this coordinated monetary easing cycle. Meanwhile, most inflation targets have not bottomed out. So in that situation, obviously the bad side, the downside is inflation, right? If you're running the economy hot, by definition, you get inflation. Now, inflation can be really bad for risk assets like equities if it triggers a Fed or a central bank reaction function. But we're seeing the opposite right now, where it's actually, they're sort of letting it ride. And so in the meantime, what does inflation do for risk assets? It leads to higher nominal revenue, basically. Net revenue in companies is a nominal metric. It's not real, and therefore, as inflation comes higher, those companies that have economics of scale, their margins will increase, their sales will increase, their profit will increase, et cetera, et cetera. So that's why the nominal assets is going to do well, is because we're seeing this running it hot at the same time that the central bank is not kicking in their hawkish reaction function. The reason why debasement hedges work even better is, because basically they don't have any sort of cost associated with it. Obviously, in an inflation regime, costs would increase as well. There's just that idea of, if gold is just a pet rock, it just sits flat there. It's not actually doing anything. The reason it appreciates is because everything else is going down, which makes it look higher. Similar idea to Bitcoin. So those are going to do really well. And then the last piece there about this emergence of fiscal dominance, and that it's not the same regime as 2010 to 2020, is because that regime was a regime where we couldn't get enough growth. We were trying to run it hot, not even run it hot, just run it at target. We were trying to throw so much money, so much quantitative easing at the wall just to get out of the fears of deflation. And that is a completely different regime than we're in now since post-COVID. And so it throws off a lot of those traditional macro metrics that people look at. It's just we're in a completely different world now. We're in this world of a very heavy-handed fiscal impulse. So you can't really look at that decade anymore. And so I think there's a lot of recency bias in a lot of people where they're not recognizing that fact that we're just in such a different regime now.
The wait is over. The Talus testnet is live. Be part of the revolution. Join now at testnet.talus.network.
Hibachi.
Provable. Trade perps with speed and security. Earn rewards. Visit hibachi.xyz. Trading on fire.
The future runs on intelligence. Creativity, engineering, health, money,
productivity. AI promised utopia, but delivered only hype, black box models, and zero accountability. With tons of tools claiming to be the best, how do you know what's real? Introducing Recall Find. Top models ranked by transparent reputation from researchers, users, and developers. Test AI skills, curate favorites, and compete to see what works. Don't guess what's good, recall it.
You know, this was another thing that we sort of outlined over the last few weeks is that, yeah, if you look, and you mentioned this with DXY, the dollar doesn't look like it's depreciating very much because it's indexed against other foreign currencies. And other foreign currencies are inflating even faster than the dollar is. And so this is kind of perpetuating the debasement trade that you're talking about and leading to Bitcoin and gold doing quite well. I want to get your takeaways from the podcast you do with Arthur and Sol, because this was kind of the topic of one of his next pieces about Bastille Day and how he's almost predicting a Frexit, a French Brexit, and France kind of going back to the franc and leaving the EU, leaving the euro, unless the European Central Bank, again, prints money, debases the euro further to kind of bail France out. And they've been also tethered to Japan and Germany for so long. And so I'm curious, did you have a chance to talk to Arthur about this? Generally, what were some of your takeaways from that conversation?
Yeah, so when I talked to him, that piece wasn't out about Bastille Day. He had just published the 47 one, which was really interesting. And yeah, I think it really hits the nail on the head in terms of how to think about, again, comparing to 2010 to 2020, we didn't even have to think about what the composition of the Fed looked like. Now we're in this completely different regime where we're more overtly politicizing and taking the Fed back closer to the political administration that's in power at the time. So yeah, I think it's the right question to be asking is what does that look like if Cook gets fired, if they can actually fire her? Obviously, the second order impact that Arthur gets into in that piece is that then in 2026, when they can go and renominate the Fed regional presidents, the governors have the veto power about whether who gets in or gets not. So typically, that's never been used as a tool to decide in terms of the composition of hawks versus doves. But I think it's increasingly likely that that's what they're going to do in 2026 is make sure that they get in all the right doves into the Fed in 2026. So that's the portion of Arthur's piece that I think is really compelling and, leads to just this even more bullish, macro environment. And then the second one in terms of Bastille Day, I haven't read it yet, but I have definitely some thoughts in terms of the original sin of Europe and the euro environment is that you have this common currency for all the different countries, but the debt is different for each country, and that's just been the headache ever since the eurozone was created. Was what I think is a mistake, which is that we, how do you navigate monetary policy in a world where the currency is set for all these countries, but then each country has a different debt profile? It just makes no sense. So that's why you've had this issue where monetary policy from the ECB has been mostly driven by whoever has the riskiest debt. So in the 2010s, it was Greece. If you just want to see a simple way of comparing this, is like looking at German bonds, like BTP bonds, compared to Italian bonds and the spread of that. And so basically, anytime that there's an issue in terms of monetary policy of the weakest link of that bond environment, so probably Italy or something like that, that's what drives monetary policy. But then it's like, well, we need a completely different monetary policy environment for Germany. Like we're in a completely different economic landscape. So you translate that to France, where you have, their long end bonds are selling off like crazy. They're in a completely different environment. So it creates these very tense potential fractures between the different countries. So I think it's going to be increasingly a bigger issue. And I think it's totally possible that we see more exits from the European Union for sure.
Yeah. And a lot of the points that Arthur made in that previous post, also Bastille Day, and in our conversation, are forecasts that are playing out on the 2 to 3 year time horizon. Really, kind of the stablecoin trade. Besant has talked about 3 trillion in stablecoins going into 2027 and 2028. And so I think that is sort of Arthur's time horizon. But Faja, I'm curious more about maybe a little bit more of a near-term time horizon. If you're looking through to the end of the year, you're looking maybe to the beginning of next year. There's a lot of, it feels like impending mania, at least the sentiment feels that way on Twitter. And so if we have all of these these monetary easing policies, all of this money printing on the horizon in the 2 to 3 year time horizon, but we have this impending, 3 to 6 month mania feeling, and then just kind of one more pump and then it's all over. How do you reconcile these? How do you balance the near term and the midterm when one feels really overinflated and the other one feels like there's still a lot more inflation to go?
Yeah, it's funny. We just went through this exercise on the latest roundup we did on forward guidance, where it's like, all right, we are all so bullish and it's just so clear to us. So it's like, all right, what's the catch here? And oftentimes the catch in those sort of situations is market structure positioning. So what we did is this deep dive into Scott Rubner, who's one of the best like flows guys in Wall Street. He was at Goldman Sachs for years, and now he just recently joined Citadel. And so he analyzes flows basically and looking at market structure positioning. And so there's a few important considerations to have in terms of gauging positioning. There's hedge fund leverage exposure, either gross or net. So gross exposure is at all-time highs, but net exposure for hedge funds is actually not at all-time highs yet. So there's a lot of hedging happening on, which increases that gross exposure, but the net exposure just isn't quite there. So that's one where it's like, all right, we're not too far extended on that one yet. The two other big systematic flows that I would look at as well, this is mostly for equities. We can get into how that correlates to crypto, but CTAs, which is just like trend programs, basically as things go higher, as momentum increases, they increase their allocation. So back in April, CTAs were completely offside. None of it was long because the trends were so bad. The momentum was so negative. So a lot of the idiosyncratic bid that we've seen in equities for the past 6 months has been CTAs repositioning. As we go higher, they buy more basically. So they're now almost maxed out. And then the last one as well is vol targeting funds. So they sort of do the same thing where as volatility comes down, they basically buy more risk. So you can see like basically as the VIX chart comes down from where it was like 60 down at, I don't even know where it is today, like probably mid-teens, they keep buying as well. So they're getting close to maxed out. So there's, like, I don't know. When I look at these market structure positionings, it's like, all right, I think we're like 75% stretched. I don't think, so I think there's a little bit more room to go. But then you compare that with, October into November, December is just such a bullish time of year. It's one of those times of year where it just feels like, people just get steamrolled if they're trying to go the other side here, especially December. Like Santa rallies are just, we just grind higher. So I don't know. I've been through enough of these that I just feel like it's important to respect that. And it's just, so far it's been clear, right? Like September is the most bearish month for Bitcoin. We were down. And then as soon as it ended, we've just been up only ever since.
Yeah. What's your take on the ever increasing amount of capital going into money market funds? I think it's almost, I think is it 8 trillion now or something, or some very, sorry, it's probably 8 billion into money market funds since like the beginning or end of last year or something. It's just been on a steady rise. Meanwhile, the stock market has obviously just been appreciating. How does that play into the market structure kind of aspects that you just mentioned?
Yeah, so it's important to consider where that money is coming from. So I think when people look at the chart, they think, oh, people are selling their S&P 500 stocks to get into money market funds because they're scared the economy is going to crash and look at all this cash sidelined. That's not the case. In reality, what it is, all right, we've seen the charts of the government interest payments, right? Like interest payments are the highest, it's above defense spending, et cetera. So that's one side of the ledger, right? The liability side on the federal government. The asset side of that is money market funds, asset under management. That's where all the T-bills are that are getting 4% on their cash. So that just keeps going into the money market funds. So what that's showing is just increased incomes, basically. It's that all these people are getting 4% on their cash. So that's pretty interesting for people to also, the one inflow into money market funds is coming from bank deposits. So it's not coming from equities or other risk capital. It's people that have a savings account at JP Morgan or something where they're getting like 0.5% on their savings. And they're like, okay, well, wait, why don't I just go into a money market fund and get 4%? Like, why am I sitting here? And it's cash that they need to be somewhat liquid, but it just makes sense to transfer it from their checking account or savings account to the money market fund. So I think it's noise in terms of saying that, it's look at all the sideline capital that's about to come into risk markets. But I think the signal is that it is increased incomes for people to spend, basically.
Yeah.
And this is actually the last step of that is that's the main driver of M2. Like you see people talking about M2 growth, and what that is basically what I just described.
Blockchain shortcuts, templates, and widgets launch without friction for builders by builders. Visit enso.build. Relay, low fees, lightning speed, and the power of multi-chain at your fingertips. Instant multi-chain payments. Choose any token on any chain. 75 plus networks supported. More than 5 million users. 8 billion plus volume processed. 70 million plus transactions. Fast, reliable, everywhere. Start swapping today. Only on Relay. Yeah. I mean, that correlation has continued to prove, whether it's a causation doesn't equal correlation type of thing, or correlation doesn't equal causation type of thing, that M2 has gone up steadily, and Bitcoin has been a good 90 days behind it consistently. I think maybe just in this last pullback, that kind of shifted a bit because of that news that you're talking about with the treasury companies, but it seems like it's kind of right back on track now. One other thing that I think is particularly on people's minds is with regards to what Trump's been saying about the tariffs, about the revenue from the tariffs, things like stimulus checks, things like giving out better numbers for certain programs, certain allocations. Trump's looking to take this tariff revenue and do something with it. And one of the things that we talked about, or that he talked about last week, was stimulus checks. What's your take on the current tariff situation? Like, if you had to just look back at the last 6 months or so of the tariffs, like, is this considered a success in the U.S.'s eyes? Why not? And do you reasonably think that we're actually going to see stimmy checks by the end of the year?
So I will say that my macro bullishness, the biggest tail risk right now is tariffs, for sure. Tariffs are a tax. Tariffs are taking money out of the system from people that spend it, either corporates or consumers, and putting it back to the government, basically. So by definition, that is a compression of spending ability by either individuals or corporations. So we've increased tariffs a lot, right? Like, if depending on how you analyze it, it's going to be somewhere between $400 and $600 billion of tariffs for 1 year. That is a huge tax hike. So that's taking money out of the economy. So there is something to be worried about, I think, in terms of what that does to economic growth. Now, the question is, have we priced that in or not? I don't really know. I interviewed somebody, George Robertson, who's deep on this topic right now, and he's very bearish for this reason. He thinks we just started a recession, and the big reason for that is this tariff dynamic. So where does that lead us? The question of what happens to that $400 to $600 billion is going to be very important for 2026. Do we take that and put out stimmy checks? That's obviously just going to be probably a net positive, because you're taking money from corporations and probably giving it to individuals. That's probably going to have yeah, exactly. And they're going to spend it, right? Like, their marginal propensity to consume is much higher. So that in that situation, oh man, that's just game on, 100%. The issue with that is that I do believe, don't quote me on this, but I do believe that they need congressional approval to do those stimmy checks. Now, does Congress actually do that? I don't know. I mean, I think there's a lot of bad taste in a lot of people's mouths about the idea of stimmy checks after how inflationary things got in 2021. So I don't know if they're going to be able to pass that one, but it's something to look at. The other side of the equation is what would happen is the Supreme Court in November, they're going to be deciding whether tariffs are lawful or not under how Trump's been doing them. And if they deem them unlawful, the U.S. government needs to refund that $400 to $600 billion. It needs to go back to people, which would be also insane. So the answer to economic growth in 2026 probably has to do with what happens with that $400 to $600 billion.
That'd be insane if they have to pay back all of the revenue that they got from tariffs.
Yeah, I don't even know how they go about doing that.
Would they? I mean, it feels like rather than it feels like we're at this impasse where you can either go the path of QE for poor people and print the money and essentially take that, not print, but you already kind of have the money from tariff revenue, give it to middle America and just generally the citizens of US. The other direction is they deem the tariffs unlawful. They force the US to refund the tariffs back to these other countries, where does that money come from? Rather than giving it to like the citizens, they print it and give it to the other countries, and the globalists win. So it really feels like we're going to come to a decision on who we're trying to benefit. Is it foreign nations, or is it, the people here at home? And I think, we know which the administration would prefer. And it's just a matter of whether Congress goes a similar direction. For sure. I'm curious a little bit about the tokenization side of things, like some of the knock-on effects of this monetary policy. So the debasement trade is certainly one thing that we're seeing play out. The other thing here is that we're seeing crypto adoption at an institutional scale like we've never seen it before, as well as regulatory. And so if there's a time when VIX spikes, these hedge funds kind of run that out, and we do kind of come back to earth a little bit, it almost feels like that time frame, like that bear market, if you want to call it that, would happen really quickly. And maybe I'm long biased, but with the news that's coming out of the SEC about stable coins as collateral for a lot of these markets, and generally just putting more and more of these assets on chain, do you think that would help to accelerate through any kind of downturn that would occur at a macro level?
Yeah, I think that probably makes sense. I guess the big question is whether whenever that happens, do we see a run up in credit creation and like under collateralized credit creation in crypto? Because obviously that was the X factor in 2021, 2022, or whatever, mostly 2022, was that we didn't realize that everything was just levered credit. And it was just like this loop. So I think, right now we don't really see that. Yes, there's some lending credit build up in the DATs, but it's pretty muted compared to what happened last cycle. We haven't seen that sort of leverage build up. Most of the lending that we do these days, people like Maple and Morpho, for them, I think they're over collateralized as well. But yeah, they're all mostly over collateralized. There's Wildcat. I know they are starting to do under collateralized lending, but overall we're just way lower. So as long as we don't build that up a bunch and we don't create that credit risk, I feel like you're right. I feel like it will shorten the amount of it. I think our correlations are much tighter to macro assets now, and the government, the fiscal authorities, the monetary authorities don't want to see that market crash for very long. We can only. It was like COVID was like a 3-week crash. Liberation Day was like a 5-day crash.
Yeah.
Like they keep getting shorter because we can't handle the strain of it because of the treasury market blows up. Like the reason they pivoted so quickly in April is because the treasury market was trying to blow up. I was like the 2 days before that, I was buying the dip, but also crashing out because I was freaking out at what I was seeing in the treasury market. And then of course, that's what led to the pivot. So yeah, I just don't think it's tenable to let that pain happen.
I think the other kind of like macro effect here that is coming from within the crypto economy is this stable coin growth as a way to kind of expand the US dollar hegemony in a global fashion. You kind of got that bucket happening, and obviously Trump, Secretary of Treasury, Bessent, and those guys are really pushing that. And then you've also got this like tokenization, 24/7 equity trading powered by settlement and stablecoins happening at the same time. And I think that's kind of what Rob was getting at with regards to how this affects, price action in terms of a downturn. But looking at this broadly with these two kind of buckets happening simultaneously, is there any material effects that we could expect on the deficit because of stablecoins, or on equities markets because of these tokenized equities being traded 24/7 in the future? Perhaps we're just accelerating towards more of this hyper-financialization and just kind of the world adapting to what crypto has been doing for the last 10, 15 years. When you're thinking about these two kind of categories here, I mean, it's probably a different conversation for each. So feel free to just kind of like start wherever you want, but curious how you see these two like kind of crypto phenomenon affecting the broader global macro picture.
Yeah, so for stablecoins, the answer lies in what do people have to sell to buy the stablecoin to use it? So if you're somebody in the US and I don't know, you're in a money market fund or something, or you're in cash or whatever, you're selling a T-bill to buy a stablecoin. The stablecoin is also a T-bill. So that's sort of net neutral. That doesn't really change the landscape. Now it's very different if you're in another country or if you're in another FX currency where you sell that, say you live in Argentina, super high inflation, a lot of issues there. You sell the Argentinian peso to buy US dollar, i.e. stablecoins, i.e. T-bills. That will lead to a marginal increase in T-bill demand, which would allow them to probably issue more T-bills and serve that landscape. So, another one would be if so you have paper currency of the US dollars and you want to swap that for T-bills, i.e. through a stablecoin, that's also another marginal increase. So I think what people get hung up a lot basically is that you have to consider what is that person selling to buy the stablecoin. Oftentimes people get tripped up and they only look at the buy. They look at, oh, look, people are buying stablecoins, but it's like, yeah, but what are you selling to actually buy that thing? Because everything has a different side to the ledger to it. So I think that we're going to head into a world where, it's very compelling for a lot of these countries to own stablecoins. Therefore, I do think it's going to increase a lot. I think the use case is for those emerging markets that have very high inflation and very weak currencies, basically. So that covers that. And then I think in terms of the broad landscape of what does it look like to get into this world where we tokenize equities, where we have 24/7 trading, like I don't see how that would do anything for the fiscal deficit, but I do think it's going to be very powerful in terms of the capital efficiency it creates. Like this has been, I have two views on crypto. Like there's one where that, there's these decentralization ideas. So Bitcoin, I'm not really convinced that anything else has really met that. Maybe like Zcash or something like that lately has been pumping. But for the most part, most assets don't really meet that threshold of what does it mean to be like truly decentralized. But that doesn't make me bearish. Like I'm not a Bitcoin maxi. Like I still believe in all the other alt currencies that we're creating in L1s. And that's because I think there's a lot of really interesting capital efficiency things that we can do. And this is one of them. And if you make capital more efficient, that means you can use it more effectively, which probably means you can increase growth. So I do see it as perhaps another tailwind to this idea of running it hot, is that if you just make capital hyper efficient, we can do more things with it, basically.
That breaks my brain when I think about tariffs, because like you said earlier, tariffs are a tax. Like that does not, that's not like free market dynamics when it really comes down to it. It's not super capital efficient. They're putting up these artificial barriers. But then I think like, well, maybe this is like some longer term theme that's playing out. Like, I kind of made a side comment about the globalists earlier, but like the EU kind of fracturing, these guys going into more localized currencies, maybe that would have been less efficient in the past, but given the infrastructure that we have now to coordinate across these currencies and maybe make foreign, Forex markets and generally markets more efficient, maybe now we have the technology to coordinate these markets and these currencies, and actually it is more efficient to go local and rather than kind of group into like one currency to rule them all. So I at a certain point, it's just we'll wait and see. We'll see how this plays out. But there's really no clear, definitive way to kind of feel out where the market is dislocated, solve that, make it more efficient, and then give those gains back to the market and generally see more growth.
I'll say the one thing, a good buddy of mine, Austin Campbell, he knows a ton about stablecoins. He developed the Paxos stablecoin. He was advising Congress on the Genius Act and stuff. He thinks that within 7 years, there's going to be hardly any other fiat currencies. He thinks like US stablecoins are just going to amalgamate everything and just eat the world. So he thinks in 8 to 10 years, there'll be a fraction of the amount of fiat currencies that exist today, which is just crazy.
And do you think there's one US stablecoin to rule them all? Or do you think do you believe in this privatized with public thesis where we have Wyoming-based stablecoins issued by the government, but then we have Walmart stablecoin, Amazon stablecoin, Libra project ends up playing out?
Actually, it's funny you say that. I just read last night, Nick Carter wrote a piece this week on that topic, and that was very interesting. I'm glad I read it in time so I can actually say something how smart, thanks to him. But yeah, I think he's correct. I think we're going to go into this world of proliferation on the back end. He talked a lot about how on the front end for the consumer, it's just going to be USD. It's just going to be dollars. But in the back end, there's going to be a lot of different stable coins that are used either internally, like a JP Morgan stablecoin, an Amazon stablecoin, or whatever. But those are all, because of the Genius Act compliance that we have now, they can all be basically fungible. They're all just going to be backed by repo or T-bills. So it doesn't really matter how it gets settled down in the back end, but in the front end, it's just going to look like US dollars. So yeah, I think in the future, I think Nick's right. I think we're going to move away from this world of just Tether and Circle and move more to this world of more privatized stablecoins. And no clear winner, no monopoly. I don't even think a duopoly like we have right now.
Yeah, very interesting. Guys, we are doing this show right now in the middle of a government shutdown. This has been a multi-day government shutdown where we are absolutely having zero progress on the ETFs that are supposed to be going through. Those crypto ETFs were supposed to be coming this month. They're now delayed by about a week, amongst other kind of facilities and efforts that governments do, which should very far and wide reaching.
Yeah. No jobs reports. There's
no
supposed
job
to be on
reports.
Friday. We got no jobs report. Yeah.
Bitcoin's ripping, and this is like, do we think that like what's going on here, Felix? Like, what is the ramifications of this government shutdown, and like, why does this just feel so tame and normal? Like, should we be a bit more worried about this?
So, yeah, people are asking me into the lead up of the shutdown what I think about it, and I was like, well, I don't think about it because I don't think it matters
at all.
Yeah, maybe not initially. Like, obviously, the longest one right now is the last one that happened in 2018, which I think was like 30 days. So I feel like I feel like the market's complacent right now and just thinking, okay, well, they're just going to do the whole show and song and dance. They're going to, try to debate for whatever wins they want to get for their sides of the party or whatever. And then we'll all move forward. And I think that's the expectation right now. And I think it's a time thing. I think if we got to the end of the month and we're about to hit that new record of shutdown and there's like zero progress, yeah, maybe then markets freak out a little bit. But I don't know. I don't really see the tangible impact. I mean, obviously right now, like, if we had that jobs report, we would have a better idea of whether we should be cutting or not in October. But in the meantime, it's sort of just like a lack of news is good news. It's just like,
well, but it's funny that just like Bitcoin bottomed more or less on that news, but then this shutdown really just feel like it just gave it a springboard it gave the market a reason to maybe buy it or at least respond to it. And since then, it's just been on a tear.
Yeah.
Gold obviously as well prior. I think gold's kind of getting a little hot here. It's at 4,000 per ounce.
Yeah, I agree. I've been swapping some gold into Bitcoin. That's kind of what I was doing. And like 109 is when I started and kind of did that up to 117. But yeah, I do agree. I think it's rotation time for sure.
And silver's going all-time highs as well as we speak. So I think that's probably a good tell for gold too.
Yeah.
So Ben Cohen thinks that, we get a slowdown here in precious metals following silver's all-time high. Q4, and you'll get a better chance to buy gold and silver sometime in first half of 2026 for then like the next kind of like bigger trade in terms of this debasement rally. Like, what is your vision for the future of Bitcoin, gold, and silver? Like, are these things just going to be, kind of going through these cycles themselves in this broader macro cycle of the debasement trade? I think we got people calling for $5,000 per ounce gold, which now doesn't seem that far-fetched. Obviously, Bitcoin, $250,000. Like, do you just see these two assets kind of going neck and neck just in their own ways throughout their own kind of like individual cycles, but through the broader kind of 5 to 10 year horizon, like the trend is up and to the right because of this debasement philosophy?
Yeah, I think yes for gold and Bitcoin. It's just like, I just harp on it. It's just like, just own both. Like, we are in the meat of the debasement trade, and I do think there's room to go. As you get further down the risk curve of precious metals and commodities, something also changes where their use cases of it change as well, and their supply demand. Like, you always have to think about supply and demand functions for commodities, because when silver rallies a bunch, suddenly it's a lot, new mines, they're a lot more profitable to be able to open and operate at a higher price. So it's like, okay, well, if gold has just 2x, I'm going to open that mine and operate it because now the financials make sense to operate at that level. So then what happens is you get more supply that comes onto the market. You get more supply into the market, and suddenly you have more supply than what the demand is requiring from it. So then you get the opposite side of the cycle where, too much supply, not enough demand, price goes down basically. And then you get that reflexive loop. So commodities are very, very reflexive. And that happens even more in copper and these other commodities as well. So silver is a funny one because it's sort of in the middle. Like gold, its supply dynamics are so, there's so much friction to it. Like it's hard to just open up a new gold mine randomly. It's a lot more difficult than something like copper. So I think something like silver sits in the middle where it has that monetary premium a little bit, but it also has that classic commodity function where as the price rallies, more mines are going to open, more supply. So that sort of will self-reflexively correct. But I think Bitcoin and gold are very unique in that circumstance, right? Like obviously Bitcoin, especially, like you never hear people talk about the difficulty adjustment anymore, but like that is such a powerful thing. Like that, as you know, as it increases, it matches it basically. So you never get that reflexive commodity unwind of supply versus demand. It always stays in equilibrium, and that's just like insane. And I think that's why Bitcoin's the best out of them all for sure.
Well, I think like the main reason why I was super curious about your take with kind of gold and silver and metals and Bitcoin is because when I'm looking at my portfolio right now, which is highly denominated in crypto, and I'm looking at like the move from crypto into like real world assets slowly. That's been like the continuous philosophy every cycle, 2017, 2021. Now we're here again, just like this consistent piling into, let's call it like safer, longer term, less volatile things. Bitcoin, ironically feels like safer than anything right now, but it's also at 125,000. So I think we can see a Bitcoin under 100K in the future. But being 25 years old, looking at the landscape here, everything is expensive. Like, what am I going to do? Buy the S&P here? Am I going to go buy property here? Like gold, like metals are just like, everything is so expensive. Is there anything in the world right now that is like that drastically undervalued that you have your eyes on? Like, is there anything that is not just like already through this massive run up and just the thought is like, oh, it could go higher versus like, oh, like the market's not responding to this? And I know I'm just kind of putting you on the spot here.
Just my bad.
When I'm looking at when I'm looking at the landscape of like what's even happening, everything just seems so expensive globally.
It is. And yeah, it's so I used to be like a value investor type person, like I got into this whole thing through intelligent investor, security analysis and all of that. So I was in the regime of thinking about, okay, well, I need to buy, decent things at a cheap price type of idea. And honestly, like I got one-shotted by that idea when I got into macro and crypto and everything, because I started to realize just how broken the system is now. Like the reason everything's expensive now is because it's a political decision to do so, basically. Like, up here in Canada, especially, like real estate is the only thing we do in this economy now, because for whatever reason, we've stopped using the natural resources that we have. Our currency used to be correlated to gas and oil, and now it's not, because we're just a real estate Ponzi. And that's like our retirement foundation for most of society. So like it's a political decision. So you have to respect that. You have to play the game. You have to dance while the music is playing from the fiscal and monetary authorities until proven otherwise. So I think this is what also like one shot so many traditional macro thinkers is they look at valuations and they're like, that's expensive. But yes, it's expensive and it'll probably get more expensiver. Now the problem is what I just said sounds like bubble talk. And that's like
that is what I was thinking. Yes,
it's the crux of the age, right? Is you're constantly balancing between mid curve and right curve. Right curve is I'm buying even though it's expensive because I know it's going to be expensiver. Mid curve is like, oh wait, this could actually just be bubble talk at the generational top. And I don't know how to navigate. Like, if you guys have ideas, let me know. But it's something that keeps me up at night.
No, but this is what I'm saying.
Insane here.
It's like you're buying, like your options of asset purchases right now are like, you're looking at it. It's like, okay, everything's expensive. It's just a matter of like, I guess what you're comfortable with, what you have conviction in, and what you're willing to hold for a longer period of time. Also, just like where your current allocations are. But yeah, that's what I'm battling with. I'm like it's just it's not like, sure, pulling money out of like the sketchy perp dex, $100 million market cap coin that you just hit a 5x on and pulling it to gold. Okay, it's probably like a reasonable play. Like that's a good sustainable wealth move. But like, looking at it from like, okay, gold, Bitcoin, land, real estate, it's kind of like, guys, like is there going to be somebody buying after me? Because, you know, like, where's the money coming from? So
yeah, it's tough, but I do, like, if you look at the history of the last 15 years, I do think it's better to be on that side than buying the value traps. Like, value has just been terrible for so many years, and it's all been growth, and I don't see any reason for that to really change. So yeah, you just kind of get, I mean, it's something like, an easy way to think about it in terms of just a crypto analog, right? Is, do I want to buy hype that is being bought back all the time, has all this revenue and everything? Or do I want to go buy, like, you know, a low float high FTV token that just unlocked after a year and is just going to be down only forever? Like, it's kind of obvious which one has a tailwind and which one has the headwind.
Yeah, and the same thing goes for macro assets. Fiscal, the host of Forward Guidance, the local macro expert on Roll Up TV. Thank you for your time, man. It's been a pleasure. Look forward to riding the Q4 wave with you together. Maybe get you back on sometime Q1 and assess 2026. Always appreciate your insights and takes, man.
Yeah, thanks, guys. Always enjoy the content you guys are putting out, and yeah, you're killing it. So always happy to be here.
You too, dude.
Thanks, brother.